Stock market investing 14 golden rules.
Stock market investment.
Stock market investment is the act of buying and selling shares of publicly traded companies with the aim of making a profit. Investing in the stock market can be a great way to build long-term wealth and achieve financial goals, but it also carries a level of risk. To succeed in the stock market, investors must follow certain principles and strategies. One of the most important golden rules of stock market investing is to never lose money. This means avoiding risky investments and having a well-diversified portfolio.
14 golden rules for stock market investment.
I have used these 14 golden rules in my portfolio and got excellent results. Let us introduce you one by one.
Never lose money.
The rule "never lose money investing" is a popular phrase often attributed to legendary investor Warren Buffett. However, this is not an accurate representation of his investment philosophy. While Buffett's investment strategy emphasizes the importance of minimizing losses, he acknowledges that all investments carry some degree of risk, and it is impossible to completely eliminate the possibility of losing money. Instead, Buffett's approach focuses on making informed investment decisions based on thorough research and analysis of a company's financial health and long-term prospects. He also emphasizes the importance of diversification and patience, holding investments for the long term and avoiding the temptation to make impulsive decisions based on short-term market fluctuations. It is essential to remember that investing always carries some degree of risk, and it is crucial to do your due diligence and make informed decisions based on your risk tolerance, financial goals, and personal circumstances.
Start small and think big.
The second golden rule of stock market investing is to start small and think big. This means that investors should begin with a modest amount of money and gradually build up their investment portfolio over time. This approach allows investors to learn the ropes of investing without taking on too much risk, and also helps them avoid making costly mistakes early on. At the same time, investors should be thinking big in terms of their long-term financial goals. By setting ambitious targets for their portfolio's growth, investors can stay motivated and focused on their long-term goals, even during periods of market volatility or uncertainty. Of course, it's important to keep in mind that investing always involves some level of risk, and there are no guarantees when it comes to the stock market. However, by starting small and thinking big, investors can position themselves for success over the long term. In addition to starting small and thinking big, it's also important for investors to have a solid understanding of their own risk tolerance and investment goals. This can help them make informed decisions about their portfolio allocation and investment strategy, and can also help them avoid making impulsive or emotional decisions during periods of market volatility. In conclusion, the second golden rule of stock market investing is to start small and think big. By taking a conservative approach to investing and gradually building up their portfolio over time, investors can position themselves for long-term success in the stock market.
Think like an owner.
Think like an owner. The third golden rule of stock market investing is to think like an owner. This means that investors should approach their investments as if they were business owners and focus on the long-term fundamentals of the companies they are investing in. When investors think like owners, they are more likely to focus on the underlying value of the companies they are investing in, rather than getting caught up in short-term market trends or hype. They are also more likely to be patient and disciplined in their investment decisions, and to hold on to their investments even during periods of market volatility. To think like an owner, investors should focus on the following. Understand the business. Investors should take the time to research and understand the companies they are investing in, including their business models, competitive advantages, and financial health. Focus on the long term. Investors should focus on the long-term prospects of the companies they are investing in, rather than getting caught up in short-term market movements or hype. Be patient and disciplined. Investors should be patient and disciplined in their investment decisions, and should hold on to their investments even during periods of market volatility. Consider dividends. Investors should consider investing in companies that pay dividends, as this can provide a reliable source of income and help to mitigate risk. By thinking like an owner, investors can position themselves for long-term success in the stock market. They will be more likely to focus on the underlying fundamentals of the companies they are investing in, rather than getting caught up in short-term market movements or hype. This approach can help investors make more informed and disciplined investment decisions, and can also help to mitigate risk over the long term.
Invest only in businesses that you understand.
The fourth golden rule of stock market investing is to invest only in businesses that you understand. This means that investors should focus on companies and industries that they have a good understanding of, and should avoid investing in companies or industries that they don't fully understand. When investors stick to investing in businesses that they understand, they are more likely to be able to evaluate the company's fundamentals and make informed investment decisions. They are also more likely to be patient and disciplined in their investment decisions, as they will have a good understanding of the company's long-term prospects and potential risks. To invest only in businesses that you understand, investors should focus on the following. Stick to your circle of competence. Investors should focus on companies and industries that they have a good understanding of, and should avoid investing in companies or industries that they don't fully understand. Do your research. Investors should take the time to research the companies they are considering investing in, including their business models, competitive advantages, financial health, and long-term prospects. Stay up to date. Investors should stay up to date on news and developments in the companies and industries they are invested in, and should adjust their investment decisions accordingly. By investing only in businesses that you understand, you can position yourself for long-term success in the stock market. You will be more likely to make informed and disciplined investment decisions, and will be better equipped to evaluate the long-term prospects and potential risks of the companies you are investing in.
Don't try to time the market. The fifth golden rule of stock market investing is to not try to time the market. This means that investors should avoid attempting to predict short-term market movements and instead focus on long-term investment goals. Market timing is an investment strategy that involves attempting to predict future market movements in order to buy or sell securities at the most advantageous times. However, studies have shown that consistently timing the market is nearly impossible and can lead to missed opportunities and significant losses. Instead, investors should focus on building a diversified portfolio of quality companies with strong fundamentals and long-term growth potential. By taking a long-term investment approach and focusing on the underlying value of the companies they are investing in, investors can avoid the pitfalls of market timing and position themselves for long-term success in the stock market. To avoid market timing, investors should focus on the following. Set long-term investment goals. Investors should set long-term investment goals and focus on building a diversified portfolio of quality companies with strong fundamentals and long-term growth potential. Stay disciplined. Investors should avoid making impulsive investment decisions based on short-term market movements or hype. Avoid market timing strategies. Investors should avoid attempting to predict short-term market movements and instead focus on the long-term fundamentals of the companies they are investing in. By avoiding market timing and taking a long-term investment approach, investors can position themselves for long-term success in the stock market. They will be more likely to make informed and disciplined investment decisions, and will be better equipped to evaluate the long-term prospects and potential risks of the companies they are investing in.
Be disciplined.
The sixth golden rule of stock market investing is to be disciplined. This means that investors should stay focused on their long-term investment goals, avoid making impulsive decisions based on short-term market movements, and stick to their investment strategy. Discipline is key to successful investing because it allows investors to stay focused on their long-term investment goals and avoid making impulsive decisions that can lead to significant losses. By staying disciplined, investors can avoid the pitfalls of emotional investing and position themselves for long-term success in the stock market. To be disciplined, investors should focus on the following. Stick to your investment strategy. Investors should develop a clear investment strategy and stick to it, even in the face of short-term market movements or hype. Stay patient. Investing is a long-term game, and investors should be patient and disciplined in their investment decisions. Avoid emotional investing. Investors should avoid making impulsive investment decisions based on fear or greed, and instead focus on the underlying value of the companies they are investing in. By being disciplined and staying focused on their long-term investment goals, investors can position themselves for success in the stock market. They will be more likely to make informed and disciplined investment decisions, and will be better equipped to evaluate the long-term prospects and potential risks of the companies they are investing in.
Always invest only excess cash, never invest all of your money.
It's important to invest only excess cash, and not to invest all of your money in the stock market. This is a key principle of risk management in investing. When you invest in the stock market, there is always a risk that you will lose some or all of your money. This risk can be minimized by investing only excess cash, which is money that you can afford to lose without affecting your daily life or your ability to pay your bills. Additionally, it's important to diversify your investments across a range of asset classes, such as stocks, bonds, and real estate. This can help to spread your risk and minimize the impact of any losses in a single asset class. Finally, it's important to have a clear investment strategy and to stick to it, even in the face of short-term market movements or hype. By staying disciplined and focused on your long-term investment goals, you can position yourself for success in the stock market while minimizing your risk of loss. In summary, always invest only excess cash and never invest all of your money in the stock market. Diversify your investments across a range of asset classes, and stay disciplined and focused on your long-term investment goals to minimize your risk of loss and position yourself for success in the stock market.
Keep tabs on trends.
Keeping tabs on trends is an important aspect of stock market investing. Trends can provide valuable insights into market conditions and help investors make informed investment decisions. One way to keep tabs on trends is to monitor the news and stay up to date with the latest economic and political developments. This can help investors identify potential opportunities and risks in the market and adjust their investment strategy accordingly. Another way to keep tabs on trends is to use technical analysis, which involves analyzing past market data to identify patterns and trends that can help predict future market movements. Technical analysis can be used to identify potential entry and exit points for specific stocks or the market as a whole. Investors should also pay attention to broader market trends, such as shifts in consumer preferences, changes in technology, and demographic shifts. These trends can have a significant impact on the performance of individual stocks and the market as a whole. In addition to monitoring trends, it's important to have a clear investment strategy and to stick to it, even in the face of short-term market movements or hype. By staying disciplined and focused on your long-term investment goals, you can position yourself for success in the stock market while minimizing your risk of loss. In summary, keeping tabs on trends is an important aspect of stock market investing. Investors should monitor the news, use technical analysis, and pay attention to broader market trends to identify potential opportunities and risks in the market. However, it's important to have a clear investment strategy and to stay disciplined and focused on your long-term investment goals to minimize your risk of loss and position yourself for success in the stock market.
Diversify your portfolio. Don't put all your eggs in one basket.
Diversification is a key principle of successful stock market investing. It involves spreading your investments across a range of asset classes, sectors, and individual stocks to minimize your risk of loss and maximize your potential for long-term growth. One of the most important aspects of diversification is avoiding putting all of your eggs in one basket. This means avoiding the temptation to invest all of your money in a single stock or sector, which can expose you to significant risk if that stock or sector performs poorly. Instead, investors should aim to diversify their portfolios across a range of stocks, sectors, and asset classes. This can help to spread risk and minimize the impact of any losses in a single investment. For example, a well-diversified portfolio might include a mix of stocks from different sectors, as well as bonds, real estate, and other asset classes. Diversification can also help investors take advantage of different market conditions and opportunities. For example, when one sector is underperforming, other sectors may be performing well, providing a cushion against losses. Overall, diversification is a key principle of successful stock market investing. By avoiding the temptation to put all of your eggs in one basket and instead spreading your investments across a range of asset classes, sectors, and individual stocks, you can minimize your risk of loss and maximize your potential for long-term growth.
Buy and go long.
Buying and holding for the long term is a common strategy used by many successful investors in the stock market. The idea behind this strategy is to identify high-quality stocks with strong fundamentals and hold them for an extended period of time, allowing them to grow in value over time. The key to success with this strategy is to focus on investing in companies that have a solid business model, a competitive advantage, and a track record of consistent growth. These types of companies are often leaders in their respective industries and are well positioned to continue growing and generating strong returns over the long term. By buying and holding these types of stocks, investors can avoid the temptation to sell too early and miss out on potential gains. Instead, they can ride out short-term market fluctuations and benefit from the compounding effect of long-term growth. Of course, it's important to keep an eye on your investments and regularly review your portfolio to ensure that your holdings are still meeting your investment objectives. However, by focusing on buying and holding high-quality stocks for the long term, investors can position themselves for success in the stock market and build wealth over time.
Buy when everyone is fearful.
Buy when everyone is fearful is a well-known investing strategy popularized by Warren Buffett, one of the most successful investors of all time. The basic idea behind this strategy is to look for buying opportunities when the market is experiencing a period of extreme fear or panic, which can lead to undervalued stocks and potentially high returns in the future. When the market is experiencing a downturn or a period of uncertainty, many investors may panic and sell off their holdings, driving down stock prices. However, by taking a contrarian approach and buying during these periods of fear, investors can potentially benefit from the market's eventual recovery. Of course, it's important to approach this strategy with caution and do your due diligence to ensure that you're investing in high-quality companies with strong fundamentals. Just because a stock is cheap doesn't necessarily mean it's a good investment. You'll still need to evaluate the company's financial health, growth potential, competitive position, and other factors before making any investment decisions. In summary, the buy when everyone is fearful strategy can be a powerful tool for long-term investors who are willing to take on some risk and have the patience to wait for the market to recover. By approaching investing with a contrarian mindset and focusing on high-quality companies with strong fundamentals, investors can potentially benefit from undervalued stocks and achieve attractive returns over time.
Be objective.
When investing in the stock market, it's important to remain objective and avoid letting emotions guide your investment decisions. This means taking a rational and analytical approach to evaluating potential investments, rather than making decisions based on fear, greed, or other emotions. To be objective, it's important to rely on data and research rather than relying on opinions or rumors. This means conducting thorough research on a company's financial health, growth potential, competitive position, and other factors that can impact its performance in the stock market. It's also important to set clear investment goals and stick to your investment strategy, even during periods of market volatility or uncertainty. This can help you avoid making impulsive decisions based on short-term market trends or emotions. One way to remain objective is to use a systematic approach to investing, such as dollar-cost averaging, which involves investing a fixed amount of money into a particular stock or fund at regular intervals, regardless of market fluctuations. This approach can help reduce the impact of short-term market volatility on your portfolio and help you stay focused on your long-term investment goals. In summary, Being objective when investing in the stock market requires discipline, patience, and a focus on data and research rather than emotions or opinions. By remaining objective and sticking to your investment strategy, you can potentially achieve attractive returns over the long term while minimizing the impact of short-term market fluctuations.
Lock in profit.
Locking in profit is a common term used by investors and traders to describe the act of selling a stock or investment that has appreciated in value in order to realize a profit. This strategy is based on the idea that it's better to take some profits off the table and reduce risk than to hold on to a stock that has already made significant gains. One approach to locking in profits is to set a target price at which you're willing to sell your stock or investment. This can help you avoid getting too greedy and holding on to a stock for too long, potentially missing out on gains or experiencing significant losses if the stock price drops. Another approach is to use a stop-loss order, which is a type of order that automatically sells your stock if the price falls below a certain level. This can help you limit your losses if the stock price drops suddenly, while also allowing you to capture gains if the price continues to rise. However, it's important to approach this strategy with caution and consider the potential tax implications of selling a stock that has appreciated in value. Additionally, you'll want to ensure that you're not selling a stock too soon and missing out on potential gains over the long term. In summary, locking in profit can be a useful strategy for investors and traders looking to reduce risk and realize gains. By setting target prices and using stop-loss orders, investors can potentially avoid getting too greedy and protect themselves from sudden market downturns. However, it's important to approach this strategy with caution and consider the potential tax implications and long-term potential of the stock before selling.
Run profits, not losses.
The phrase "run profits, not losses" is a common adage in the investing world, which essentially means that investors should focus on maximizing their gains while minimizing their losses. This approach involves being disciplined and having a clear investment strategy in place, with a focus on long-term growth and risk management. One way to run profits is to hold on to stocks that have appreciated in value and continue to show strong growth potential. By holding on to these stocks, investors can potentially realize significant gains over time, as long as the company's performance remains strong. Another approach is to use trailing stop-loss orders, which automatically sell a stock if the price falls below a certain percentage from its highest point. This can help investors capture gains while also limiting potential losses, as the order is adjusted as the stock price continues to rise. On the other hand, running losses means that investors should cut their losses and sell stocks that have experienced significant declines in value. This approach involves being disciplined and setting clear stop-loss points for each investment, which can help limit potential losses and protect investors from significant downturns. In summary, the run profits, not losses approach involves being disciplined, having a clear investment strategy in place, and focusing on long-term growth and risk management. By holding on to stocks with strong growth potential and using stop-loss orders to limit potential losses, investors can potentially achieve attractive returns while minimizing their risk exposure. Thanks for watching. Please don't forget to subscribe.